Hello, this is Bob Dunn at Private Wealth Management Group. At Private Wealth Management Group, we are dedicated to educating clients about our philosophy, or in some cases, retraining some to think prudently about investing. Many times this involves diverting the conversation from discussing the intricacies of the markets and the implementation process. This does not mean we are not actively seeking ways to improve your investment outcomes. It's just that we want you to focus on the matters that you may control. That focus remains the same, but for those that are seeking more evidence in our efforts and additional investment insight, we'll now be offering a quarterly webinar. Private Wealth has been growing. We expanded our investment committee by partnering with Mario Nardone of East Bay Financial Services to fill the Chief Investment Strategist role a couple of months ago. We've been working with Mario, reviewing everything from our philosophy and strategy to implementation. Mario will complement and enhance what we've already been delivering. His knowledge as a chartered financial analyst and years of experience in the investment world will add greater depth and structure to our investment management process at Private Wealth. His addition is going very smoothly, and we'll be providing you with updates along the way. This is just one sample of what we have been working on to improve your experience. With that said, I would like to introduce Mario Nardone.
Thanks, Bob. Appreciate the opportunity to work with you and to present this overview today, as well as all the additional work we're going to be doing together and providing on behalf of your clients. Just to give you a little bit of a preview, what we're going to be talking about today is primarily a review of the market and economic environment from the first quarter this year as a way to sort of put perspective around our investment strategies and the results you most likely experienced in your portfolios. We understand that everybody's goals and risk tolerance that we utilize in order to meet your financial goals, so this isn't really able to be customized for your exact situation. So if you wanted to talk about your personal rate of return, how your portfolio is positioned against a specific market environment, please feel free to reach out, and we'll be more than happy to address it on that more specific level. So with that, let's start our conversation with a general review of the overall U.S. economy. As you probably know, the U.S. economy has been growing continuously month over month for about 105 months through March. That makes this expansion the third longest on record, dating back to 1900. It leaves a lot of economists and market participants and observers an opportunity to question whether or not we have a lot more room to run. One of the things we have to consider is that growth in output, which we measure by a factor called GDP, or gross domestic product, is a function of two major factors: growth in the labor force and productivity per worker. And if you've noticed, U.S. unemployment is currently sitting at about 4% and continuing to decline. That means that for every 100 people that want a job, there are only 4 that can't find one. So if you think about that, the labor force really has very little room to grow. And despite all of the conversation about technology and robotics and automation, our economy is actually declining in the rate of productivity growth per worker. So the question on everyone's mind is, how is this economy going to continue to expand? What happens when we end up in a tight labor environment like this is typically employers have to raise wages in order to entice people out into the workforce. And what happens then is those employers have to pass on those increasing wage costs in the form of rising prices for us as consumers of the goods and services that they produce. So all that being said, what we need to consider is that a long expansion could result in higher wage growth, higher prices, and that translates into the definition of the term inflation. So what you're looking at on this slide is a path that the inflation rate has taken since the early 70s. And you may have experienced it yourself, or you may have heard that in the 70s and 80s, we had double-digit inflation. But since then, that is pretty much unheard of. As we move to the right, we get up to present day. And we'll focus on the dark colored line here. So that measure tells us what is the average increase in the price of goods and services year over year. And as you can see, if you look at where the line is on the graph, we're sitting somewhere around 2%. That number is really important because that is the rate of inflation that the Federal Reserve targets, and that's why I have that cute little target symbol over there on the right, indicating where they want to see inflation. The reason for that, and some might wonder, why would you want increasing prices? Really, the whole idea behind a 2% target inflation rate is to prevent deflation. Anytime prices decline, you end up with really challenging environments in business and economics. So the idea isn't that we really want prices to go up, we just don't want them to go down, and 2% is a good buffer. So if we think about it, over the long term, the average inflation rate is just south of 4%. And with the last 15, 20 years or so, inflation has been well below that. The problem with this, and that, obviously that's a good news story, but it could be a good news, bad news story. To hear that inflation remains in check, there's a problem of whether it's, what I say here is too in check. The graph that you're looking at here was produced by Vanguard, a mutual fund company that's widely respected and very strong in their economic analysis. This chart, which they published in early this year, highlights the narrow range of inflation forecasts and illustrates that as elevated confidence in the status quo. The way to read this is they look at economists' view of what they think inflation is going to be. The blue line is the typical distribution among economists that obviously use different factors and different techniques for forecasting this kind of thing. So if you look at where that same group of economic forecasters sit today, they have a much more confident concentration about what inflation is going to be around that 1.8 percent per year range. The problem with complacency is that it makes you a lot more susceptible to shocks. So if we ended up with an inflation shock, all of these expectations that you see represented in this chart are undermined, and they're all currently priced into assets, stocks, bonds, and what have you. So if there is a shock that few people were expecting, you could end up with a volatile asset market. So we definitely don't want to ever get political, but this is actually where I feel the topic of tariffs is the most relevant. And this is really where I think most consumers need to be aware of in terms of the trade war conversations that are going on. So obviously, the idea behind putting tariffs on something is to prevent foreign economies from having the upper hand in selling their goods in our country, potentially undermining our own domestic manufacturing and services sector. The problem is you may have tangential results that could disrupt the global supply chain. For instance, you may end up having tariffs on a component part of something that's produced here in the United States for which there is no or very few replacements or substitutes. So if a company that produces a finished product has to pay more for the underlying component, then that's going to be passed on in the form of higher prices for us. So we need to all, as consumers and investors, be very careful in understanding economic policy and even not getting complacent in our own expectations around inflation. I think that's where Bob and his team really come into play in their one-on-one conversations with you. Is, as he said in the intro, there are a lot of things in your financial world that you can control, one of which is understanding how the changing prices of your consumption can impact your overall financial plan. On the other side, we need to be aware that inflation impacts the value of our investment holdings, so it's our job to make sure that every one of our clients is sufficiently insulated against that rising prices in the long run. One of the things that I already mentioned that we can sort of take solace in is that the Federal Reserve's primary goal, one of their primary goals, is to make sure they keep inflation in check. So what you're looking at here is the path that the Fed funds rate has taken since 1999. So really, just to illustrate what we're talking about here, the Fed funds rate is effectively the rate the Fed decides to be the minimum borrowing rate in our economy. So if they say the minimum rate is going to be 5%, then every other rate has to be built off of that, essentially higher than that. And if that's the lowest borrowing rate, then a rate of, say, 5% would prevent people and companies from making a lot of investments because that elevates their hurdle rate. So if they're borrowing at 5%, then whatever they're investing in has to have a rate of return higher than that. So in the time of a recession like we had in the late 2007, 8, 9, that sort of thing, the Fed was aware that their Fed funds rate was too high. So in order to stimulate the economy, they start dropping that rate, and they had to drop it all the way to 0 and keep it at 0 for around five years in order to get our economy running again. As signs started to materialize that the economy was getting back in good shape, you start seeing the Fed step up the Fed funds rate. And what you're looking at to the right with the dotted lines really are various measures of expectations of where that Fed funds rate can and might go. And importantly, the thing that I think is really something that the Fed doesn't really comment on a lot, but I'm sure has in the back of their mind, is that I don't think that they want to go higher than 3%. And if they can control the Fed funds rate through signaling what their intentions are and through gradual increases in that rate, then I do feel that they can get to a stable economy without having to raise the rate over 3%. And the reason why they probably don't want to do that is because the U.S. has never gone into recession when the Fed funds rate has been less than 3%. So I guess, long story short, fingers crossed that we don't end up in that situation. For now, the Federal Reserve has been managing that particular component of the economy quite well. So let's turn away from the U.S. for a moment. And I think this is going to be one of the major recurring themes in our investment conversations going forward, at least for the foreseeable future. Looks like there's a lot going on this chart. This is what we call a heat map. So in this particular chart, which starts back in 2008, it takes a measure of the manufacturing sector of each country represented here. And we don't need to go into how it's calculated, but on the right side, you see a score. Basically, a score greater than 50 means that the manufacturing sector of that country is growing. If it's less than 50, it's shrinking. So obviously, a strong economy is growing in their output. You look at this red column back in 2008, that represents the financial crisis and the Great Recession, from which it's obvious no economy really was able to escape. In 2012, we had another pretty significant negative economic period, and that was with the European debt crisis. So as we move further to the right and up until present day, you're starting to see less and less red and more green. And in fact, you have yellow to green across the board for all the global economies mentioned here. So what we're looking at here is a situation of coordinated global growth. So it's actually really refreshing to see that even as the United States economic expansion might be slowing down, might be coming to a halt, it's great to see that we have the world's economies sort of in sync to potentially pick up some of that slack. And I want you to keep that in mind as we start talking about global securities markets, which we'll do a quick overview now. So I have this comment on here that this chart is essentially showing you major asset class performance, or what I like to say is that diversification means always having to say, I'm sorry. One of the primary tenets of our investment philosophy is to remain diversified among uncorrelated asset classes at all times. And uncorrelated means something in the portfolio may be zigging while something else is zagging. So likely is that you have something that's doing well and maybe something that is uncorrelated isn't doing so well. So if we look at the last 3 years of performance of the major asset classes, and just to give you a quick overview, not that you need to memorize what all of these indexes represent, but basically we go from bonds. The Barclays aggregate indexes are bonds. The S&P 500 and Russell 2000 represent U.S. large cap and small company stocks. And then the MSCI indices represent international categories or non-U.S. stocks. And then we have this REIT index, and REIT stand for Real Estate Investment Trust. And that's how we get exposure to commercial real estate investments in our portfolio. So over the last 3 years, obviously different asset classes have performed differently, but over that entire period, every single one of them has been positive. So that is reflective of a strong U.S. stock market and a strengthening global economy. Over the last year, you see the U.S. stock market has done well itself, with the yellow and red bars representing large and small cap stocks. But really, the story has been international stock market investments. Part of that has to do with that concerted global growth or coordinated global growth I just mentioned. Another part of it has to do with the declining dollar, which we'll talk about in a minute. But the negative story, and the one that we're saying I'm sorry for right now, is the REIT investments, the Real Estate Investment Trust. Part of that has to do with the slowing growth in the United States. Part of it has to do with the fact that REITs are very yield-oriented investments, and they're very interest rate sensitive, almost to the point that bonds are. So we'll talk a little bit about interest rates in a minute, but just keep that in the back of your mind that real estate investment trusts are interest rate sensitive. So now that we talked a little bit about the economy and an overview of the markets, let's take a little bit of a deeper dive into the different asset classes that you find in your portfolio. And I have a subtitle here that says bonds are not boring, and that's me being a little bit defensive, because I think that bonds are among the most interesting types of investments. Personally, I enjoy things that are hard truths like science and math, and bonds are, for the most part, harder truths than things that are driven by human behaviors such as the stock market. Not to say I don't enjoy learning about and investing in the stock market, but bonds just intuitively make more sense. You might not think so just staring at this graph, so let me try to make sense of that. We're going to focus on this dark line here. This represents something called the yield curve. So think about every point along this line as representing a United States Treasury bond with a maturity that corresponds to the x-axis down here. Now, as you go up the y-axis, using the key on the right here, this is telling you what the yield of that particular Treasury bond is at that moment. So, for instance, if you had a 3-month Treasury, you'd find the 3-month section, go up, find the line, move across, and you're somewhere in the 1.7% range. So that means if you bought a U.S. Treasury today that matured in 3 months, you'd get about 1.7 or 1.8% yield. Now, as you move up this curve, the yield that you receive goes up because they call that term risk. And what that really means is you're being paid, you're being compensated for buying a longer-term bond or allowing the Treasury to use your investment for a longer period of time. And in order for you to lock up your money for a longer period of time, they need to entice you with higher yields. That's why they call this the yield curve. And this is a very normal shaped yield curve. It continues to go up all the way to 30 years. I'm not going to get into too much depth right now, but in terms of investment strategy, one of the things we like to look at is to recognize that we could extend our term risk and get essentially a one-to-one relationship in terms of adding time and earning additional yield until we get out to 5, 7, and 10 years when the curve starts flattening out. And what that means is that if we took a 10-year bond and we're getting 2.8%, we may have to go all the way out to a 25-year bond to get another 0.2%. That's a lot of risk to get a little bit of incremental return, which is why you'll see, and you do see, that our portfolio on the bond side is more heavily concentrated on short and intermediate term. But luckily for us, since these are all extremely pathetic yields in themselves, getting no more than 3% even for a 30-year bond is definitely a historical low number. But luckily for us, we have more options than just treasuries. This chart is also busy, so I'm just going to call your attention to very important parts of it. This is essentially showing the risk-reward trade-off of various bond types. And in this case, risk equals interest rate sensitivity, and that's the green bar. Return represents yield, and that's the blue bar. So let's look at an index that represents U.S. Treasury bonds. What we're seeing here is an average yield of 2.5 and an average interest rate risk of 6.2. So just think about that ratio. We don't need to go into the math of how that's calculated, but think about that ratio and the ratio of the size of the bars, and that's U.S. Treasuries. Now let's look at U.S. credits, which is another name for corporate issued bonds. So we move from treasuries into credits. Yes, our yield goes up to 3.7, but our interest rate risk goes up to 7.3. So that might be a trade-off we're willing to accept, but it's still not the best. That's still a pretty tough ratio. So this square in the middle with the crown on it is what I would consider to be the sweet spot of the bond market, at least right now, where we can get a 3.5% yield with a 4.5 essentially percent interest rate risk. That is the best trade-off in the bond market today. You might pause your screen and start looking around and see that these two on the far right are extremely more beneficial if you use the logic that I just mentioned. But what you need to know about that is that these are lower credit quality categories, which have a whole different set of risks. So I wouldn't even put those in the same type of category. Over the long term, this chart shows the risk-return trade-off going all the way back to 1992 of various bond types and components. And again, this is really just for education. And you're going to be seeing this quarter after quarter, so eventually it might make sense. But if you do want to have a more in-depth conversation now, or if there's something that requires more explanation, just let us know. But basically, using that same risk and return type framework, we start at the left with very low risk bond categories. These are short-term treasuries, municipal bonds, shown in yellow, and short-term corporates. Then in the middle, as you'd expect, you have some of the intermediate term categories, intermediate term corporates, intermediate term municipal bonds. And then what happens here is instead of having a one-to-one relationship of risk and return, it starts trailing off as you get into the longer term types of securities. So again, you have to take a lot more volatility risk to get a little bit more rate of return when you start talking about long-term bond categories. And we just wanted to impress that upon our audience. On a more recent note, these are all those different bond components and how they've returned recently. Over the last year, you see, generally speaking, bonds have been, as you'd expect, in the 1% range. This black bar represents the Barclays U.S. Aggregate, probably the most widely known bond index. We're not going to get into all the details, but the most important thing you can see here is the year-to-date. For the first quarter, and again, this ends March 31st, we have to realize that interest rates rose during that period of time, and it was because of some of the inflationary fears materializing that I mentioned earlier. We're going to talk about that in just a second, but the point I want to make is that pretty much across the board, bonds were negative in the first quarter, and there was virtually no escaping it. The only thing you could have done is you could have held short-term municipal bonds that are a little bit less interest rate sensitive, or you could have invested in non-U.S. bonds. And the only reason why they did well was because of the dollar's depreciation during that period. That might be a good point to make. One thing that often strikes people as surprising is that when the dollar declines, it actually has a positive impact on your non-dollar holdings. So if you think about it like this, if you're buying a non-US bond, you have to trade out of your dollars and into a foreign currency. And then when you get out of that bond, you translate it back to dollars. So if your dollar is depreciated over that period, you actually end up buying more dollars back than you could have at the beginning of the period. So a declining dollar is actually a good thing for investors in non-dollar assets. Now let's turn our attention to the stock market. This graph shows you the prior 12 months, so starting March 31st of 2017, ending March 31st of this year. And for the first part of that period, you see pretty much a steady climb upward with not much volatility. You don't see too many ups and downs in that graph. But then, I think the operative phrase here, these are all the headlines that have occurred through that period. I don't really like where they place this on the grid, but really this comment that says inflation starts to make a comeback really represents this steep decline that occurred in January. What happened there is that the labor report came out basically saying that we added another couple 100,000 more jobs. Now, going back to the earlier conversation about tighter employment usually results in higher wages, in turn encourages inflation. Again, inflation is something the Fed watches, so the market made all of these inferences all of a sudden that a better jobs report was going to lead to inflation, going to lead to higher interest rates, and that did nothing more than spook the stock market. Fundamental valuations of underlying stocks are perfectly acceptable. I wouldn't say normal. I wouldn't say average, but they're acceptable. But this particular market environment served to spook the market into a little bit of a sell-off that it since has recovered from. But nonetheless, that's what happened in that period. And what that also did is kick off a little bit more volatility in the market than we're used to. What we're looking at here is an index of the VIX, or the Volatility Index. And again, we don't need to know how it's calculated, but higher observations means more volatility. So back in the financial crisis, the VIX was extremely high. The price of stocks were going up and down, mostly down, at a record clip. But as you can see, throughout time, volatility peaks and then settles down, and then peaks and then settles down. And it just goes through these cycles. And so what happened last year is that, we had seen fairly low or no volatility throughout 2017. And again, that topic of complacency settles in, where market observers and participants just get used to not having a lot of volatility. Then all of a sudden we get volatility, and people seem to panic a little bit. But as I said down here, I don't think, the headlines that said volatility is back with a vengeance was a little bit of sensationalism, if you ask me. Really, what we're observing is perfectly normal market behavior. So now let's look at some of the experience of the various types of the U.S. Parts of the U.S. stock market. And again, eventually you may know exactly what each of these indices represents, but the most important thing that I'll call to your attention on this screen has to do with growth-oriented investments. So the yellow represents large companies that have a high probability of future earnings growth. And investors that like those kind of companies are oftentimes indifferent about the underlying price of the stock. So that type of investing is called growth investing. This is where a lot of your tech companies reside. A lot of them have really bright futures, but not necessarily a lot of earnings today. Growth, both in large company stocks and small company stocks, have really been where it's at for the last number of years, almost 5 years or more, but especially over the last 1 year. So I just wanted to call that to your attention, and also specify that, one of the reasons why we all work well together Bob and his team and myself, is that we share a philosophy rooted in academic literature and rigorous historical analysis that says that over the long run, value-oriented investment philosophy actually outperforms growth, although that does come and go in cycles. And what I mean by that is value-oriented investment is one where we pay attention to the fundamentals of the underlying companies and buy those companies at a discount. Some famous value investors you might have heard of include Benjamin Graham, and in today's world, Warren Buffett is definitely a value-oriented investor. Growth certainly shines occasionally, so sometimes we just have to wait out those cycles and make sure that our faith in the buy low, sell high approach is unshaken. If you wanted to talk more about that, we'll be happy to do that. Now we look at non-U.S. Stock markets. And without even going into any of what these indexes represent, all you need to do is look at the one-year numbers and see that investments in non-U.S. stocks significantly outperform their U.S. counterparts, especially in a number of categories. Part of that has to do with that global expansion. Part of that has to do with the declining dollar, but all of it has to do with why we have non-U.S. stocks in our portfolio. Now, all of that we just said was to explain what happened in the past, and a little bit of the why. But what it doesn't tell us is anything about the future. And for that, we need to look at something called valuations. Now, valuation is a broad term that basically means you're looking at what the current stock price is relative to some underlying financial or accounting-based calculation. So, for instance, on this chart, we're using forward earnings. So what are the consensus forward earnings of the S&P 500 companies? And the way we use this graph is JP Morgan took data from 1993, and they plotted every single quarterly observation of the S&P 500's forward PE, or price to earnings ratio, meaning how much are we willing to pay for a company's stock for every dollar of its earnings. So as you move to the right, it means the stock market is placing a higher premium on earnings with a higher price to earnings ratio. So for every one of those quarterly observations, they plot on the x-axis. They plot on the y-axis what was the forward 5-year returns after that observation. So the trend line indicates that the lower the starting price to earnings ratio, the higher the subsequent rate of return was. And that makes sense. If you're paying a higher price for it, you would expect to have a lower rate of return going forward because you have a lot more of a price hurdle to get over. So the moral of the story is that despite this extremely long run in the stock market, we still have reasonable valuation. So at the time of this observation, the price to earnings ratio of the S&P 500 was 16.4. And that would correspond to, historically speaking, an average expected annual 5-year rate of return of 7 or 8%, depending on how precise you can be with this graph. But essentially, that is an average expected long-term rate of return. So all that to say that despite having a market that has gone extremely high, valuations are still in an area where we would expect positive returns going forward. And that's exactly why we would never try to make a tactical move and pull all of our assets out of the stock market. And looking at it another way and incorporating non-U.S. investments using a valuation metric, we're looking at price to book ratios. So now instead of using earnings in the calculation, we use the accounting value or book value of the underlying company. Now by that metric, we're looking at the orange bar or orange dot that reflects the current price to book ratio of large company U.S. stocks, small company U.S. stocks, and non-U.S. So all you need to know is that according to price to book ratio, the current valuation is on the high side relative to the category's 15-year average. So it's high for U.S. stocks, high for U.S. small cap stocks, but average or below average for non-U.S. investments. So again, this just continues to strengthen the case for having a diversified portfolio that includes non-U.S. investments. And just to end on a graph that ties it all together and sort of in a comprehensive way, we have another risk-return chart where, again, we have risk on the left, volatility at the bottom. So what we're trying to do, we want to be in the top left quadrant, right? That's ideal. But what I really use this chart for is to show you that over the long term, there is an absolute pattern for risk and return. So again, towards the left and the bottom of the page, we have the Barclays U.S. Aggregate Bond Index. So low risk, low return. Actually, cash is down here at the bottom. Very low risk, very low return. Then you have U.S. bonds, non-U.S. bonds. You have the S&P 500, which are essentially the 500 largest and most reputable, depending on your definition, companies in the U.S. economy. You have non-U.S. stocks, which have underperformed recently, but again, if you look back to all the fundamentals, as we look forward, they look like they may be poised to do better. Then you have frontier markets, which are very, I don't want to say very risky, but they have risks in and of themselves. You have small company U.S. stocks, you have emerging market stocks, and you have commercial real estate. So as you move up the risk spectrum, you're rewarded with higher rates of return. So to sort of tie that all up is to say, we believe that capital markets work. We know that it's not going to line up like this in any given quarter or any given year or even 3 years, but if your time horizon is sufficiently long, these are the results that we would expect. And it's our job collectively as your advisory team to construct the right combination of these assets to, one, meet or exceed each of your financial goals, while two, not taking any more risk than you may want or need. So with that, that's the end of my prepared remarks. I know it may have left more questions than answers, so feel free to reach out to Bob or Ryan, give them a call, let them know, hey, Mario said something on this particular slide. I'd like to have a little more information about that, or let's talk about how it coincides with your own investment experience, and I'd be looking forward to having that conversation with you. So I appreciate your attention today, and I look forward to speaking with you again.